In this lecture, we will cover the CFA Level 2 reading on long-lived assets. Here again, you will see a lot of overlap between this reading and the long-lived assets reading that you studied at Level 1. There are a few major items covered in this reading. One has to do with capitalizing versus expensing. At times there is subjectivity involved as to whether an expense is expensed through the income statement or whether it is capitalized, and you as an analyst need to make adjustments when you are comparing companies with different policies. We will also study the impact of depreciation in detail. We'll then look at impairment and revaluation of long-lived assets. We will learn how to study the disclosures, and then finally we will talk about leasing. First, capitalizing versus expensing. Generally, long-lived assets are recorded at an amount equal to the acquisition cost plus the cost to get the asset ready for its intended use. This is your standard treatment. However, IFRS explicitly specifies the following: the cost of an item of property, plant, or equipment shall be recognized as an asset if and only if it is probable that future economic benefits associated with the item will flow to the entity, and the cost of the item can be measured reliably. So if these two things are true, if these two conditions are true, then you capitalize, and with capitalization what we are doing is showing an asset on the balance sheet. What value do we show on the balance sheet? The amount of money that you spend on the asset plus the money that you spend on making the asset ready for use. I don't think you will be tested on this at Level 2 because there has been a sufficient amount of time spent on this concept at Level 1. What if these conditions do not hold true? For example, if the cost will have an uncertain impact or no impact on future earnings, then what do? Then you have to expense, which means that you show the expense on the income statement and reduce your income for the period where the money has been spent. Why are we studying this? Because at times there is subjectivity involved over here. Different companies might have different judgment. So you as an analyst need to make adjustments when you compare. Example 1 illustrates a scenario where you have two companies that are very similar. One expenses and the other capitalizes. So the company called Cap will capitalize. The company called Now is going to expense. Now they both start with 1,000 cash and 1,000 equity. They have the same revenue. The first company and the second company, both companies purchase equipment for 900. Both companies have expenses other than this of 500 per year. Cap does straight line depreciation over 3 years, which means that it purchased this equipment for 900. So what is it going to show? It is going to show a depreciation expense of 300, 300 and 300 over years 1, 2 and 3. What will Now do? Now is going to show the entire 900 as an expense in year 1. All right. We are also given the tax rate. And then here are the questions. Which company reports higher net income over the 3 years? What is the difference in total cash flow? What is the difference in cash from operations? Do you think there will be differences in the numbers reported over the 3 years? Yes, there will be. Is there any economic difference between the two companies? Not really. From an investment perspective, they are identical, but clearly because they are using different methods, the numbers are different. The return on equity, profit margins, so these ratios are also going to be different over the years. The taxes paid over the years are also going to be different. In many cases, you will notice that the cumulative effect over 3 years is the same, but each year when looked at separately, you will have different numbers. I am going to highlight the important points over here, and then there'll be a separate video going into details. But I think this is fairly straightforward, and I actually want you to try solving this on your own before you look at the solution. The first question is, which company reports higher net income over the 3 years? And then we also want to look at the cash flow numbers on the recording. So here we are looking at the numbers for CAP on the left and now on the right. Notice that the cash expense other than the expense related to the $900 equipment is the same. But with CAP, the depreciation is 300 spread over 3 years, so total is 900. Whereas with now, the total 900 is shown as a cash expense. So that is why the net income, or actually let's look at the income before tax first. The income before tax is only 100 for now in year 1, and it is 700 for CAP. Okay, CAP has a higher income because only 300 is being taken as an expense. But then what about the tax? CAP is paying a higher tax over here because the earnings before tax is higher, whereas now is paying a lower tax. Net income is 490 for CAP, and net income is only 70 for now. What about over the 3 years? If you take numbers over the 3 years, 490 plus 490 plus 490, so in both cases the numbers over the 3 years will be the same. Here you have 70 plus 700 and 700, so you are going to have 1470 in both cases. But when you take time value of money into account, then this would be better. But accountants who don't worry about time value of money will say that we have the same situation. Also notice that the income variability is higher over here because we are taking a big lumpy expense in the now scenario, whereas in the CAP scenario, the expense is spread over a period of time. You can figure out the other numbers over here. They are fairly straightforward, and then I'll also make a separate video available on this. Question 2 deals with ROE and net profit margins. What you will see on the left is the calculation of equity. Time 0, equity is the same for both companies, but then the equity numbers are different after that. On the previous slide, we calculated the net income numbers. Here we are calculating the equity numbers. So the ROE numbers are going to be different. The ROE for the capitalized company is going to be higher in the first year relative to the expense company. And this is intuitive because with the capitalized company, in the year of the expense, we are only taking the depreciation number. So the net income is higher. But in subsequent years, the ROE is going to be higher for now because there is no depreciation expense involved for the now company. All right. And with net profit margin, notice that the net profit margin is the same for all 3 years for CAP, whereas for now there is more variability. Very low profit margin in the first year because we take the big hit, but then the profit margin numbers are better in subsequent years. I want you to also do these calculations. They are fairly straightforward. Why does now report a change in cash of 70 versus CAP, which reports a change of cash of minus 110? You can work through the numbers here, but the big difference is the tax. Who is paying more tax? Actually, CAP is going to pay more tax in year 1 because CAP has a higher profit. So when the profit is higher, obviously it is paying more tax. So will that impact the cash flow? It will, because the tax payment is a very real cash flow. So that explains the difference. This is a very important table for you to understand, and it's quite testable. When you are comparing a company which capitalizes versus a company which expenses, the total assets are going to be higher for the company which is capitalizing, obviously, because that's what capitalization means. All these other numbers are fairly self-evident, and I want you to go through this and make sure you understand and remember them. Some of these items and ratios that you might have an issue with. So let's look at CFO. Why is CFO higher for the capitalizing firm? The reason is that if a firm is capitalizing, then the money spent, let's take the example that we just saw, the 900 spent, this is going to go in the investing bucket and not in the operating budget. So the cash flow from operations will be higher for the capitalizing firm, and using the same logic, the cash flow from investing would be lower for the capitalizing firm, because this 900 is going in the CFI, cash flow from investing bucket, and reducing the CFI because it is money out. Debt to equity ratio, notice that the debt is not impacted by the decision of whether to capitalize or expense. So the liability is not impacted. The asset number is going to be higher for the capitalizing firm. If the asset number is higher, that means that the equity number is higher. If the equity number is higher, then the debt to equity is lower for the capitalizing firm. Interest coverage ratio is important. Initially, when the money is spent, your interest coverage ratio is higher for the capitalizing firm. So what is the interest coverage ratio? It is your operating profit, or EBIT, divided by the interest expense. In the initial year, EBIT is going to be higher for the capitalizing firm. Since EBIT is higher, the interest coverage is higher. But what about subsequent years? In subsequent years, the EBIT is going to be lower for the capitalizing firm because depreciation is included in EBIT, and depreciation reduces EBIT. Therefore, we have a lower number for the capitalizing firm. Return on assets. Return on assets is net income over assets. In the initial year, the year where the money is spent, the net income is going to be higher for the capitalizing firm. The asset is also going to be higher, but generally the percentage increase in net income is much more than the percentage increase in assets. So overall, this ratio will increase. Now I want you to do example 2 from the curriculum. It is a very short and simple example. Section 2.1 deals with the capitalization of interest costs. For constructed assets, interest costs during construction must be capitalized as part of the asset cost. What does this result in? Capitalized interest causes the following: higher net income during the period of capitalization. Why? Because the interest paid, rather than showing up as an expense on the income statement, is showing up on the balance sheet, and therefore the net income will be higher while you are capitalizing. This will also result in higher asset values, which I just implied, because the interest is being capitalized. And depreciation. If you have higher asset values, that means that the depreciation will be higher. and this will lead to lower net income, EBIT and interest coverage over subsequent periods. So there's a period when you are capitalizing, but then subsequent periods, once the construction is done, then you have an asset that is valued relatively high because of the capitalized interest. So since the asset value is relatively high, what's going to be the depreciation amount? That is also going to be relatively high. If the depreciation is relatively high, then what happens in subsequent years to EBIT? EBIT is going to be lower. Remember, depreciation is an operating expense, even though it's not a cash expense. So EBIT is lower, and net income is also going to be lower in subsequent years, and interest coverage is also going to be lower in subsequent years because EBIT is lower. Here is an example from the curriculum, example 3, and I want you to do this example. So let us make sure we understand what's going on. Notice that we are given EBIT for 3 years. We are given the interest expense. This interest expense does not include the capitalized interest. The capitalized interest is 2,200 in 07, 6,000 in 06. Even though this is money that is being spent, but it is not showing up as an expense on the income statement. This money is being capitalized as indicated right here. We are also given the cash flow provided by operating activities and cash flow used in investing activities. Here is the first question now. We need to calculate and interpret the interest coverage ratio with and without capitalized interest. And we are given the following, that the capitalized interest increases depreciation expense by 475,000 in 08 and 07 and by 365,000 in 06. What is the interest coverage ratio? This is an important ratio and we've talked about it earlier. The interest coverage ratio is simply EBIT divided by the interest. Here is what you should come up with. This row shows the interest coverage ratio with no adjustments. 10.61 is simply the EBIT number which is shown divided by the interest expense. What if there is an adjustment? The capitalized interest in 2008 is 0, so you don't worry about that. But you are given this information that capitalized interest increases depreciation expense by 475. Now you need to pull out the effect of this 475. If you pull out this higher depreciation, what happens to EBIT? Does it go up or down? The EBIT actually goes up, because if you are removing the depreciation expense of 475, then EBIT should go up. So to come up with this number, you will take the reported EBIT, you will add 475, that's your numerator, and then you divide that number by the interest expense, 4764. In 2008, you do not adjust the interest expense because we are assuming 0 capitalized interest in 08. So that's how you get this number. What about 07? This number is straightforward. It is simply the reported EBIT divided by the interest expense. What about this number, 10.54? You take the reported EBIT and add the depreciation number here, 475 for 07. So take this number, add 475, that gives you the numerator. And what's the denominator? You take the interest expense number that is reported and you add 2,200, because what you are considering here is the actual interest payment. your actual interest payment is equal to this number plus the 2,200. 2,200 does not show up as an expense on the income statement, but it is money that you are spending. So you add that number and you will end up with 10.54. Apply the same logic to 06 and you will get these numbers. Now notice that when you do the adjustment, what happens to the coverage ratio? In both cases, the coverage ratio actually comes down in 07 and 06, where you do have capitalized interest. And this illustrates that if you as an analyst are trying to figure out the capacity of a company to repay debt, then it makes sense to look at the adjusted ratios. Those give you a better indication of a company's ability to make payments. The next question has to do with the percentage change in operating cash flow between these years and these years. And you assume for simplicity that financial reporting does not affect reporting for income taxes. And you are also asked what were the effects of capitalized interest on operating and investing cash flow. So look at this and then I'll explain the main points. The full solution is obviously in the curriculum, but you need to understand the core points, which I will do with you in the video. The most important thing to understand here is the adjusted CFO. Now recognize the fact that this 2,200 is currently reported in the CFI or the investing bucket in the cash flow statement. But when you make an adjustment, you need to say that this 2,200 is hitting the CFO bucket, the cash flow from operations. And since this is money spent, it should reduce the cash flow from operations. The reported cash flow from operations in 07 equal this number, 14,980. From that you subtract 2,200 and you come up with this number. The same logic is used in 2006. In 2008, we do not have any capitalized interest, so the CFO does not need to be adjusted. Once you have these numbers, then you can easily look at the percentage changes. So to summarize the main points here, capitalized interest reduces CFI and increases CFO. And when you do the adjustment, then obviously you need to do the opposite, which is what we just did over here. Capitalized interest increases depreciation expense, and we have seen that. The entire interest amount, capitalized and expensed, should be used to calculate coverage ratios, and that is what we did with our adjusted numbers. And why should this be done? Because you as an analyst are typically evaluating a company's ability to pay, so you should be looking at how much interest payment is actually being made and not just at the interest amount shown on the income statement. Next, we come to the capitalization of internal development costs. Generally speaking, the costs to internally develop intangible assets are expensed when incurred. That is the ground rule, but there are some exceptions, and you need to understand those exceptions. One of the exceptions is that under IFRS, the cost can be capitalized if certain criteria are met. So if you are developing an intangible asset internally, the research part where you are evaluating feasibility, that is going to be expensed for sure. But once that is done and now the feasibility is established and you are sure you will build a product that you will ultimately sell, then the development cost can be capitalized. And again, emphasizing can be. This is not saying that you have to capitalize, you are saying that it can be capitalized. And you can imagine that there is a fair amount of subjectivity involved, so you as an analyst need to be careful when you are comparing companies. What about US GAAP? Costs incurred to develop a software product for sale are expensed until the product's feasibility is established and capitalized after the product's feasibility has been established. So until the feasibility is established, you expense, and after that you capitalize. Remember, this is an exception, and this is an exception in the context of software products that a company is developing for sale. So clearly this will apply to software companies like Microsoft and Oracle and so on. What if a company like General Electric is creating software for its own use and not to sell? Then the costs incurred to develop the software for internal use are capitalized. There is a full example on a software company that we will look at briefly. You as an analyst should also consider the impact of internally developing versus acquiring intangible assets. Why is this important? When a company acquires intangible assets, then obviously a company is paying for the intangible assets based on fair value, and then no matter how that intangible asset was developed, you are going to show that intangible asset at fair value in your books. You are comparing company A, which purchased a particular intangible asset, and company B, which developed, let's say, the exact same sort of intangible asset. Economically, they are similar, but will the book value be the same? Not necessarily, because a company that developed internally might have expensed most of what was spent on the internally developed product. So financial statement numbers will be very different, though economic reality will be similar. And you as an analyst need to understand that. You should also consider the impact of expensing versus capitalizing on ratios. And the analysis is similar to what we have seen earlier. Now take a look at example 4 in the curriculum. This is a somewhat difficult example, and I'm going to give you the most important points here, which will help you solve this problem. I'm not going to run through this problem in the lecture. The basic idea here is to look at the impact on various ratios, such as the PE ratio, the price to cash flow ratio, and so on, with numbers as reported and with adjusted numbers. So what sort of adjustments are we talking about here? The adjustment that we need to look at is if the company had expensed rather than capitalized its investment in software. So we have a particular company, which is a software company, and what it is doing is capitalizing. If it is capitalizing, then the company is making its income statement look relatively good. And what do you as an analyst need to do? You need to adjust numbers and assume that if the company had expensed, then what would the numbers look like? And you will notice here, this is the final numbers after all the adjustments. The PE ratio, you are given the stock price, which is 42. What's the PE ratio? It is the stock price divided by earnings. So as reported number is 30, but when you adjust, then what happens to the earnings number? The earnings number will decrease. The earnings number will decrease because now you are taking money that was capitalized and put it in the expense bucket. So expenses goes up, earnings down. If earnings is down, then what will happen to PE? It goes up. And notice the substantial difference that you see in the various adjusted numbers. Now I think many students I've noticed get stuck on this problem, and I'll tell you where people get stuck. There is this footnote which says that there's this asterisk which connects with this asterisk over here. Net cash used in investing is this amount, and this says that includes software development expense of and includes capital expenditure of this much. Now, there are two issues with the way this is written. Ideally, the way it should be written is include software development expense of 6,000. So this is actually, up till here, should be one line item. It is a little bit confusing the way it is written. And then capital expenditure of 2,000. So there are two separate line items that are muddled together. That's one point. The other subtle point is the wording. This says software development expense, which will make you think that this is an expense, but this is actually the capitalized amount. So the use of the word expense is tricky. Okay, expense in the sense that in the English usage expense, that the money was spent, but that money spent on software was actually capitalized from an accounting perspective. And how do we know that? Because it is included in the investing activity. So 6,000 was included in the investing activity. If it was included in the investing activity, that means it was not shown as a operating expense. Right now, with that in mind, you can try to work through the numbers, but that's where many people get hung up. Hopefully, you now understand this point. Moving now to section 3 of this reading, which is depreciation. Depreciation is the allocation of an asset's cost over time. It is not a cash expense, but a real and significant operating expense. When you spend 900 on a given machine, that was money spent in year 1, but it was not all expensed in year 1. Depreciation allows you to spread this expense over the useful life of the machine. There is a concept of carrying value, which is the value at which an asset is shown on the balance sheet. When you initially buy an asset, you will show it at 900, that's the carrying value. At the end of year 1, you will show the asset at 600, because that is the amount you have after the depreciation. At the end of year 2, the carrying amount will be 300, and so on. The historical cost is the original amount that you paid. You should also understand the distinction between accounting depreciation and economic depreciation. Accounting depreciation is based on accounting rules. If you decide to use straight line depreciation, then the accounting depreciation here every year is 300. Simple. Now, it is possible that economically the value of the machine at the end of the first year is down to 500. In other words, if you were to try and sell this machine, the value is only 500. So economic depreciation would then be 400. The economic depreciation is the change in the actual economic value of the machine. So understand that distinction. In FRA, we will generally be talking about accounting depreciation. So the default interpretation of depreciation would be accounting depreciation. In economics, when we talk about depreciation, then the default would be economic depreciation. There are several depreciation methods. The major ones that we need to be aware of are shown right here. Straight line methods, and here is one of the simplest calculations you will see for calculating the depreciation expense using the straight line method. The advantage of this method is that you allocate the expense equally over the useful life of the machine. Then you have different accelerated depreciation methods, such as the declining balance method, or you can have MAC-RS. The principle behind these methods is that you depreciate more initially and less later. One of your favorite topics in level 1 was related to income taxes, where we used straight line depreciation on the financial statements and accelerated depreciation on tax statements. Unlike LIFO and FIFO, where you need to use the same method on the tax side and financial reporting side, with depreciation you have the flexibility to use different methods. Typically companies do straight line on the financial reporting side and accelerated reporting on the tax side. And then you can also have production-based methods such as the units of production method, where the amount of depreciation is based on how much was produced. Example 5 illustrates the difference between companies that are using a straight line method. So there is a company called Evenly which is using straight line depreciation, and a company called Sooner which is using accelerated depreciation, so it is depreciating more sooner. This is a straightforward example and I want you to try this. We will also make a video available that explains this example in case you have issues, but over the years very few people have had issues with this example. At the end of the example, this table should become obvious to you. Most of these are fairly obvious. I'll just highlight the last two over here. Turnover ratios have an income statement number in the numerator and a balance sheet number in the denominator. So a typical turnover ratio might be the asset turnover ratio, which would be sales divided by assets. With straight line and accelerated, the sales number is the same, but with straight line, your assets number is going to be higher. At least in the initial years, straight line depreciation will be less. And since the depreciation is less, the carrying value of the asset will be more. The denominator is more, so the overall ratio is lower. Therefore, you notice that the turnover ratios will be lower. What about the cash flow in early years? With straight line, the depreciation amount is less compared to accelerated depreciation. Since the depreciation is less, the profit will be higher. Higher profit means that the tax will be higher. Tax is a real cash flow. Higher taxes means that the overall cash flow will be lower. Estimates required for depreciation calculations. This is fairly straightforward. To calculate depreciation, you need an estimate for the useful life of equipment. You need the expected residual value. A longer useful life and higher expected residual value decrease the amount of depreciation. This is fairly straightforward. Example 6 is based on what we have just talked about. It is fairly straightforward and I want you to try this before I give you the solution. This is a very simple example. For part 1, you simply do the initial cost, 1.1 million minus the residual value over the useful life of 5 years. So you get 200,000. For part 2, in year 3, the depreciation is 200,000. Now, if there is a change in the useful life, here is what's happening. At the end of year 2, the carrying amount is 700,000, but we are now saying that we have 6 more years. If we have 6 more years, then the depreciation will come down to 100,000. And notice that this is important from an analyst perspective. Companies can manipulate their earnings by changing their estimates. And when an estimate changes, you as an analyst need to understand why that estimate is changing. Section 4, impairment and revaluation of long-lived assets. This has 2 sections. The first section deals with impairment of long-lived tangible assets, and the other section deals with revaluation. Revaluation is only allowed in IFRS. It is an alternative method. It is not allowed in US GAAP. Here is something that should look familiar because we studied this at level 1. What is impairment, first of all? It is the unexpected reduction in the value of an asset, as opposed to depreciation, which is the planned reduction in the value of an asset. IFRS and US GAAP have a different method of coming up with impairment. Here is what IFRS says. You impair if the carrying value, this is the value on the balance sheet, is greater than the recoverable amount. And then what is the loss reported? The impairment loss is simply the difference between the carrying value and the recoverable amount. The next question becomes, what is the recoverable amount? The recoverable amount is the greater of fair value less cost to sell. This looks a lot like NRV, but NRV is used in the context of inventory. Here we simply say fair value less cost to sell. In any case, recoverable amount is the greater of this number and value in use. The question then is, what is value in use? Value in use is simply the present value of future cash flows. The impairment loss is reversible. All right, IFRS generally allows you to write back up. What does US GAAP say? US GAAP says that there needs to be a two-step process. The first step involves recoverability. So it's a litmus test. Is the asset impaired or not impaired? An asset is impaired if the carrying value is greater than the asset's future undiscounted cash flows. So this is the big difference. If the undiscounted cash flows are greater than the carrying value, then you do not need to impair. Let's say that the carrying value is 100 and the asset's future undiscounted cash flows are 90. Then you need to impair. How much is the impairment loss? It is the difference between the fair value and the carrying amount. Do we simply take the difference of these two numbers? No, because this was just the test. Then you have to figure out the fair value. All right, and the fair value can be calculated using, the methods that we have discussed here. And the impairment loss is not reversible. If you spend enough time with this material, then it becomes easier to remember these concepts, because you can get a sense for the fact that both with inventories and with this particular topic, the IFRS concepts remain the same and the US GAAP concepts remain the same. Let's look at example 7 now, implications of impairment charges in financial statement analysis. This looks like a lot of information, but it is actually fairly straightforward. Here I have summarized the points. So the company initially buys an asset where the carrying amount is 2000. Then there is an adverse event and the amount has to be written down. The company evaluates that this machine will produce a cash flow of 300 for 5 years and the discount rate is 10%. If you pull out your financial calculator, you can calculate that the fair value, this FV stands for fair value, which is actually the present value, not to be confused with future value. This is the fair value is 1137. So what is the impairment loss? The impairment loss would be 2000 minus 1137, which is this number. The working has been done for you. What the CFA Institute wants is that you do some analysis. Where will the impairment loss appear in the financial statements? Obviously, on the balance sheet, the asset will be written down. And then in the income statement, there will be a loss associated with impairment. So there will be an impairment charge of 863, which will reduce profits. On the cash flow statement, if you are using the indirect method, then there will be an adjustment related to the impairment loss because this is not an actual cash flow. How should the impairment loss be viewed in the context of evaluating past earnings and cash flow? When there is an impairment loss, one of the things that you need to evaluate is whether the company was depreciating properly or not. In other words, perhaps the impairment is happening because the depreciation expense used in the past was not sufficient. That is not always the case, but as an analyst you should figure out, is this company being very aggressive about its depreciation mechanism? That is the main point. The curriculum makes other points too, which you should read. How should the impairment loss be viewed in the context of projecting future earnings and cash flows? The typical response here is that write-down should not be considered a recurring cost. If all is normal, then the write-down happens in a given year, which reduces net income, but you do not expect that impairment to keep happening. If a company has a history of doing impairments, then that is a larger problem that you need to look into. And then the final question is compare and contrast the determination and reporting of any impairment loss under IFRS and US GAAP. In this particular case, when you do the recoverability test, you are comparing 2000 with the sum of the undiscounted cash flows, which is 1500. Since this number 1500 is less than 2000, you need to impair. How much do you impair? The impairment amount is not based on 1500, it is then based on the fair value. So in this simple question, we have the same answer or the same impact on the financial statements regardless of whether you use IFRS or US GAAP. What if on the exam you get a scenario where the 300 is for 7 years? In that case, there will be a difference between US GAAP and IFRS, because with IFRS you will still look at the fair value, but with US GAAP you will compare 2000 with 2100 and you will say no impairment. So recognize that difference. What is the impact of impairment on ratios? Impairment reduces the value of assets and equity, obviously. It is recognized as a loss on the income statement. ROA and ROE will go down in the year of impairment because your income is impacted, but it will be higher in subsequent years because your denominator will be lower. Asset turnover will be higher in subsequent years, again because your denominator is lower. And remember that impairment losses can be used to manage earnings. You might have a new management team which wants to show a positive trend, so they take impairment losses right up front, which makes numbers look bad when they start, but then after that it is easier to show improvements. And this is related to the Sunbeam case that you might or might not recall from level 1. Revaluation of long-lived assets. This is an alternate to the historical model. Historical model basically says that you depreciate and where necessary you impair. The revaluation model is allowed under IFRS, and basically the model says that assets should be reported at fair value. Any decrease in asset value is reported as a loss. Subsequent increase is shown as income as long as the original loss is not exceeded. If there is a further increase, then the asset value can be shown at a number higher than the original amount, but the amount higher than original doesn't flow through the income statement, it goes straight to equity as other comprehensive income. The appraisal of fair value of an asset involves considerable judgment and discretion, and generally we should look at external sources to come up with reliable estimates. Here is a rather straightforward example that I want you to do. You might have a situation where a company writes up its asset value because it wants to show a better debt ratio. And that is the scenario over here. I want you to actually try to solve this example before looking at the solution. And there will also be a video available for this particular example. And you will notice that this is the solution. With asset revaluation, the leverage ratio is 1.99. Without asset revaluation, that means we are pulling out the impact, the leverage ratio actually goes up. This is actually a negative sign. When the leverage ratio is high, that means the company is more risky. So as an analyst, you need to be aware of this. Increasing the value of the asset through revaluation decreases leverage. That's what's happening here. Therefore, this company, RevUp, appears to have more capacity for any new debt. Okay, it appears to have the capacity to take on more money. Also, if you recall from level 1, there are debt covenants, and there might be a debt covenant which says that the leverage ratio needs to remain below 2. If you know that this debt covenant exists and you see behavior like this, that should make you as an analyst quite suspicious. Alright, even though this is just a few decimal places, but if there is a debt covenant with a specific number, then those few decimal places can be quite important. Alright, do this on your own. If you have issues, then you can look at the solution or look at the video.